Well, let's talk to Jane Foley, who's the head of FX strategy at Rabobank in London. Always good to have you on Global Business, Jane. So, look, dollar yen often moves quietly in the background, but right now it's commanding attention. Why should global investors be watching this pair so closely beyond the headlines?
Well, for starters, these are two of the biggest economies in the world, so it really does matter. But there's more than that. There's a lot of politics here as well. As you mentioned, Trump, well, historically has been associated with a want for a softer dollar, so that potentially the US could export more. And what's quite interesting is those comments quite recently, a few days ago, from the Japanese Prime Minister, which were very Trump-like, also suggesting that Japan could export more because of a weaker yen. But of course, if you're looking at the dollar-yen exchange rate, well, both currencies can't be weak at the same time. And what we have now is the yen extremely weak on a broad base. And the dollar, whilst it weakened a lot against the euro last year, the dollar is relatively strong against the Japanese yen. Now, that is something that the US Treasury don't like. And last month, there was a lot of speculation as to whether the US Treasury, combined with Japan's Ministry of Finance, could actually intervene in order to try and strengthen the yen. But those comments from the Japanese Prime Minister recently have really confused that signalling.
And how have those comments sort of fed in to that yen sell-off? And I suppose what I'm asking you is what it really tells us about investor expectations for the Japanese economy.
Well, the investors, for instance, are looking at Japan in perhaps different ways. If you look at the Nikkei stock market, well, that's been quite attractive, partly because the yen has been so cheap. So if you want to buy assets within Japan, well, they're going to be cheaper when their exchange rate is so soft. But there's also been other things going on in Japan. The country, of course, is emerging after 30 years of deflation, and that has a different story for investors. So, for instance, you don't really invest in assets when you think the price will drop, but when you re-emerge into an inflationary environment, then assets suddenly become a lot more attractive. And that's something that the Japanese government is very aware of, and it's trying to get its own domestic savers to use their stockpiles of cash and invest in assets, and that too could provide opportunities for international investors. So the equity market will be looked at quite differently to the yen. And what's really spooking investors looking at the yen is the size of Japan's government debt. As a percentage of GDP, it's really the largest in the world. And the market is concerned that the current Prime Minister, her policies may increase the size of this debt because she has indicated that she'd like to spend more of taxpayers' money and then more debt as well. And that's what's worrying investors right now.
So that's the Japan story. What about knock-on effect, Jane? Equities, bonds and flows into Asia? Because you mentioned that international investors have a keen eye on this.
They do, and this is really because of the size of that debt market that I just mentioned, the Japanese government bond market. It's absolutely enormous. And what we've seen is yields of the JGBs going up really quite strongly. Now, there are various reasons for that. When inflation happens, well, it's natural for long-term interest rates of government bond yields to push higher. The Bank of Japan is also buying less JGB markets. It's buying a lot, and now it wants to normalize its balance sheet. And that's probably the primary reason why we've seen this move higher in yields. But the market is a bit more concerned just about the debt, whether or not there is enough investors out there to absorb all this extra paper that might be coming onto the market. And because of the sheer size of the JGB market, the market's worried whether or not maybe some investors that are currently investing in maybe US Treasuries may look at the yields in the JGB market and swap and sell their US Treasuries, for instance, and buy JGB yields. So it does have a knock-on effect. A market as big as the JGB market will impact yields and has done in recent months in other markets as well.
Jane Foley at Rabobank, thank you very much indeed.